Have you ever opened your trading app and you saw that all your stocks are green and you feel like a financial genius? Just for you to come back only a few months later and you watch your stocks all turn red and you feel like withdrawing all the money and hiding it under your mattress. Welcome back to my YouTube channel. And if you're new here, welcome to Investing with Chisum, where I teach you everything you need to know about investing. If you're new to investing, you'd have probably heard people throw around these words bull market or bear market. What do they actually mean, and how do you protect your hard-earned money, especially during the times when the market turns upside down? Today we'll be breaking down the bull market and the bear market. We'll be talking about what causes them, how to spot them, and what you should do when this occurs so that you don't lose your mind when things get rough. If you want to invest with confidence, hit the like button and subscribe. Let's get into it. Let's start with the fun one, bull market. Think of the bull market as a bull thrusting his horn upwards. So that is why the bull market represents the rising stock prices in the stock market. Usually during this time, the economy is doing well, companies are making profits, people are getting jobs, businesses are expanding. So with this, people are more optimistic and they rush to buy stocks. What does it feel like? It feels like easy money. It is a time that you buy stocks and next week it's up 10%. So at this time, everybody feels like a financial genius. And this is where the downside comes in, because now everyone feels like, oh, this stock is going up, so probably it's a good stock. People tend to buy bad stocks at this time. So people tend to buy bad stocks at this time, forgetting that a tree does not keep growing to the sky. Quick question for you. When was the last time you bought a stock during the bull market and you felt like a pro? Let me know in the comments. And while you're down there, hit the like button and subscribe so that you don't miss out. Now, let's talk about the part that most people are scared of, the bear market. Think of a bear as an animal that swipes his paws downwards. So a bear market is when the market prices are going down more than 20%. So from its recent highs. So there is a negative mood and it could stick for months or even years. What does it feel like? What causes them? Usually it is driven by high interest rates, rising fear, bad economic news, high inflation rates, or changes in government policy, which slows business growth. And as a result, people immediately start selling because they want to save the little money they have left. As a result, prices drop, panic spreads, and the market slumps. Here is why the bear market is important to you as a beginner. It's uncomfortable. Watching your account drop week after week really tests your emotions. But here's why many beginners make a mistake here. They get scared and they immediately sell at a heavy loss and swear they will never touch stocks again. But seasoned investors don't behave like that. They understand that when there is a bear market, it's not the end of the world, rather they see it as a clearance sale. If you've ever had a mini heart attack and you decided to sell because of your stocks were in the red, hit the subscribe button. We're about to talk about how to survive this anytime the market cycles into this. So you're in a red and your stocks are bleeding. Let's walk through 4 rules for beginners. Rule number 1, do not panic sell. So your stock is going down and it's bleeding and you feel like you need to take this money out because you're losing a lot of money. Pause. This is not the time to sell. If you bought strong, healthy companies, then the price is not falling because the business is doing badly. It's most likely because the market is scared. So your business is still doing well. Unless the reason you bought the shares has changed, you should not exit just because of fear. Rule number 2, think of it as a clearance sale. Imagine you love buying shoes and a brand of shoes that you're a fan of is on a 40% discount. You won't cry and stop buying these shoes, you'd buy more, right? So that's the same thing that applies in the bear market. So strong companies with great management and steady profits are usually dragged down when the market is panicking. So this is your chance to buy these stocks at cheaper prices. Why don't you grab the opportunity? Rule number 3, keep some cash in the sidelines. Never invest 100% of your cash. Always have some cash reserve, so if the market is bearish, you can easily take the bargains. And when I talk about bargains, I'm talking about the good stocks that are at a lower price right now. This will be your chance to quickly buy it because you left some dry powder for you to use and buy it. Rule number 4, lean into strong dividend payers. So when you're investing, lean into strong dividend payers, as in companies that give you consistent dividends, steady dividends, so that when there's a bear market, when the prices are down, you still get cash flow payouts, as in the dividends, that can cover you until the market heals. So how do we tie all this together so that you don't lose sleep? So first of all, know your risk tolerance. If a 15% drop in your portfolio will give you sleepless nights, maybe you are holding too many aggressive stocks, and you should look into adding fixed income and more stable assets. Second, you should build a long-term mindset. The stock market is for the long term. You must have heard this a million times now. The stock market is for a long term. So we have the bull markets, which are fun and easy to handle, and the bear markets when things are tough. But history tells us that every single time, in the long run, everyone wins. Another way to go around this is to automate your investments. So instead of trying to time the market, you can simply just invest a fixed amount every single month, so that when there is a bear market, you buy more, and when is a bull market, you buy less at these high prices. So let me explain the logic. During the bear market, right, the prices are lower, so you get to buy more quantity of that stock. Then during the bull market, the prices are higher and you buy less. At the end of the day, bull markets and bear markets are all natural parts of the investing journey. You cannot stop winter from coming, but you can definitely dress from them. Understanding how these two markets work will allow you to move from an anxious beginner to a smart, confident investor. So if you enjoyed this video and you learned something from it, hit that like button, leave a comment below letting me know if you prefer buying in the bull market or you want to headhunt during the bear market for good bargains. And don't forget to subscribe so that you don't miss our next deep dive. Thank you for watching. Stay smart in your investments and see you in the next video.